Hi, this is Jaden Mosley, and today I'm going to be talking about the monetary policy. And in order to do that, I'm going to be using a scenario in which the monetary policy may come in handy. So the question is, in Zamuda, the required reserve ratio is 10%. Assume that the central bank sells $70 million in government securities on the open market. Part A, calculate the following. The first question in Part A is the total change in the reserves in the banking system. So in order to understand this, you have to understand what reserves are and how they work. There's two types of reserves. There's excess reserves and the required reserves. The required reserve is the percent of money that must be held in the vault so that depositors have access to their money. In order to find the required reserves, you must have the required ratio, which we can see right here is 10%, and you must have the deposit, which is $70 million. So excess reserves is basically the money that the banks can loan out. The total change in the reserves, the actual reserve, which is the required reserve and the excess reserves put together, is 70 million due to the fact that a deposit in the bank changes the reserves by however much that deposit is. So the answer for this question would be $70 million. Okay, for part two, we're going to be finding the maximum possible change in the money supply. Now this problem is going to take a little bit more calculations due to the fact that you're trying to find the maximum change in money supply. The formula for that is ER, which is excess reserves, times the money multiplier, which is 1 divided by your required reserve ratio, which is 0.1 for us, plus your demand deposits, which is $70 million. In order to find our ER, we must first find our RR, or our required reserves. In order to find our required reserves, must do 70, our demand deposits, times 0.10, which is our required reserve ratio. In order to find our excess reserves, we must subtract our demand deposits from our required reserves, and that will give us $63 million. Now that we found our ER and RR, we got to find our money multiplier, which our money multiplier, like I stated earlier, is 1 divided by 0.1, which will give us 10. So now that we have all our variables mapped out and accounted for, all we have to do is plug them into the formula. So we'll do 63 times 10 plus 70. And if after you calculate this, your answer should be 700 million. For part B, the question is, using a correctly labeled graph of the money market, show the impact of the central bank's bond sale on the nominal interest rate of a money. This is the definition of a money market graph. I represents the nominal interest rate, and Q represents the money. These two lines right here are the money supply lines. This one is money supply 1, and this line basically represents money supply at its equilibrium, where no monetary policy has been implemented yet. And this red line over here is going to represent money supply 2. The graph can either shift left or right depending on what monetary policy is being implemented. In our case, we're going to be doing the contractionary policy, or as it's more commonly known as tight money. This is a policy used in order to combat inflation. So basically for this policy, the government will sell bonds. Now the open market operation is the most important of the 3 monetary tools. It is when the Fed buys or sells government securities. When the Fed sells bonds from the government, the money supply will decrease. The required reserve ratio will increase, the discount rate will increase, bank reserves will decrease. Like I said earlier, the money supply will decrease, and the federal funds rate will increase. Basically, the federal funds rate is the interest rate that the banks charge other banks for overnight loans. This is the contractionary monetary policy. If the contractionary monetary policy is in effect, the graph, the MS money supply will shift to the left. Oh, before I forgot, make sure that you have the I's, the interest rates. If without these, you're not going to know you're not going to know where the interest rate is. I mean, even though you can see it on the graph, it's still, you need these in order to know exactly where the interest rates are. It's very, very important on the graph. Black diagonal line. This line represents DM, which is the demand for money. Now this is the graph for a contractionary monetary policy, but what if we were going to do, what if the question asks for the buying of bonds? That would mean that we're going to be going into an expansionary monetary policy, which is basically the exact opposite of a contractionary monetary policy. It is considered easy money. Expansionary is used for when we're in a recession. The open market operations will buy bonds. The federal government will buy bonds in that situation. The required reserve ratio will decrease. The discount rate will decrease. The bank reserves will increase. Money supply will increase, and federal funds rate will decrease. Basically, interest rates will decrease and the money supply will increase. And that's the difference between a contractionary and expansionary monetary policy. And that's it for question B. We'll move on to question C. So question C asks, what is the impact of the central bank's bond sale on the equilibrium price level? Now this question doesn't need any type of calculations. It basically just needs understanding of how the monetary policy affects the economy. If you understand contractionary and expansionary monetary policy, and you know that in the contractionary we sell bonds and that the money supply decreases, you know that the interest rates will increase. If interest rates increase, that means the required reserve ratio is also increasing. And if the required reserve ratio is increasing, aggregate demand is decreasing. Now, if there's less demand for a product in the economy, the price level for that product will decrease. And that's it for this video. Thank you for watching.